In this video, we will learn about the market for collateralized loan obligations, or CLOs. Leveraged loans, the instruments that are packaged into CLOs, are essential to corporate America and global finance. Mid to large cap companies and their sponsors come to the leveraged loan market to raise senior secured debt to finance their operations, buy new assets, acquire companies, and to refinance existing debt. Over the past 10 years, issuance of these leveraged loans has surged. As issuance of leveraged loans has increased, so has the importance of CLOs. CLOs are key buyers of these leveraged loans and have come to dominate the market, taking up over 2/3 of market share in 2024. So what exactly is a CLO? A CLO is a securitized product backed by a pool of individual leveraged loans. These loans are first pooled and then securitized into a deal, which is in turn sliced up into different buckets called tranches. Different tranches appeal to different investors as they vary in their risk versus return profile. The highest tranche, typically rated AAA, is the least risky, while the tranches further down the capital structure carry more risk and are rated below investment grade. They do, however, come with a higher coupon and discount to compensate for the higher risk. The lowest tranche is the equity, which does not accrue a coupon and is the first to absorb losses in a CLO. The entire CLO vehicle receives payments from the underlying pool of loans backing the deal and then pays out the tranches in a predefined order called the deal waterfall that is set out in a deal's governing document called an indenture. If a deal is passing all written tests in the indenture, the equity tranche receives all residual cash flows that remain after the tranches above it have been paid. An important question that comes to mind is, why take a pool of loans and create a CLO in the first place? The answer is relatively simple. The different tranches cater to different investor bases. Less risky tranches are favored by investors with a more conservative investment mandate and a lower risk tolerance, while investors who are more tolerant of risk and are looking for higher yields invest in lower-rated tranches. Banks, with their low risk tolerance and attractive cost of funding, are the largest investors in the safest portion of the capital structure, the AAA tranche, while mutual funds, insurance companies, and pensions make up a majority of the investor base in the middle portion of a CLO, also known as junior or mezzanine debt. Hedge funds and private equity firms with a higher return mandate are the largest investors in CLO equity. CLOs are different than other types of structured products like residential mortgage-backed securities, or RMBS, and commercial mortgage-backed securities, or CMBS. CLOs are dynamic and actively managed, while RMBS and CMBS deals are static. CLOs are managed by CLO collateral managers that trade the underlying pool of loans to manage a CLO's overall risk-return profile. The rules around trading, among others, are governed by the CLO's indenture. Future videos will discuss how managers can affect the value of a deal and its tranches. In the next video, we begin to understand how Hildene uses its investment paradigm to value and invest in these CLOs.